Today, we are joined by subject matter experts from EHTC to provide an overview on navigating the latest stimulus package, what's new and different from packages in the past, and what businesses need to know to prepare for the application process. After months of inaction in Washington, it was important they got this done. Late last week, the Chamber released the results of our annual West Michigan Business Advocacy Survey to our membership, reaffirming the need for support for impacted businesses to see them through the winter and until enough of the community can be vaccinated. Chantel will go ahead and share the link to the full survey results in the chat. Here are a few key takeaways from the survey. More than 700 members responded to our survey. The top 3 issues are COVID-19 relief and recovery, a talented workforce, and healthcare affordability. 70% of respondents said the business climate was favorable, down from 94% the previous year. Usually this number is in the mid to high 90s for reference. Over 44% of business owners and executives stated revenue is down by more than 26% from this time last year. 46% of these respondents said that they need financial assistance to stay viable, and 23% are at risk of closing under current conditions within the next 12 months. Our top priority for 2021 is to continue providing resources, guidance, and advocacy to help the West Michigan business community overcome the pandemic. And we know this federal stimulus will play a large role in getting Michigan and our nation back on track. Today's town hall is brought to you by the Chamber's Tax and Regulatory Affairs Committee. This committee is one of 5 issue committees our government affairs team staff. Other committees include Education and Workforce Development, Healthcare and Human Resources, Transportation, and Environmental Affairs. If you'd like to get more involved in our work and help craft our legislative priorities, we encourage you to connect with a member on our team. Chantel is dropping the committees and email addresses of the government affairs staff member who leads each committee in the chat. We would love to have you at the table. Let's jump in. Today, we are joined by Tax and Regulatory Affairs Committee Chair Dave Echelbarger, President of EHTC, and his colleague Mike Young, Senior Manager. Welcome and thank you both for your time today and your willingness to reschedule this important conversation. We're going to start off with a presentation by Dave and Mike that will cover what we know today, including the latest information on a timeline and guidance from the U.S. Department of Treasury and the Small Business Administration. We will have time for questions, so please post them in the chat as you think of them. We will do our best to address them during and after the presentation. Dave and Mike, take it away.
Good morning. Thanks, Alexa. So today, our Grand Rapids Chamber Town Hall on the Consolidated Appropriations Act of 2021. Would you advance to the next slide there? And as Alexa noted, that I am the managing partner at EHTC and the chair of the Tax and Regulatory Affairs Committee at the Chamber. Also serve on the First National Bank of Michigan Board of Directors, which gives me a unique insight into both sides from the tax and the financing perspective, as well as the immediate past chair of our Michigan Association of CPAs. And as Alexa said, I've got our senior tax manager, Mike Young, who leads our transaction advisory team as well at EHTC. So go ahead in the next slide. Thank you. Our agenda today is going to really be focused on the Consolidated Appropriations Act, and which there's been a lot of confusion up front when we first started hearing about this, and you'll hear it mostly referred to now as CAA. Collectively, it was a bill from the COVID-19 relief bill and the omnibus spending bill. So there's a lot of different bills and acts that came together to what we know today as the Consolidated Appropriations Act. Our goal today, as Alexa said, is to provide an awareness of what's different this time around, what's changed with the act that was passed into law when the president signed it back on December 27th. So again, we're going to focus on some recent updates as of last Friday. We're going to focus on an overview of the PPP, which we're going to divide that into the first draw and to the second draw. We're going to talk about eligible expenses, the changes in forgiveness. Another big topic is the employee retention credit. They brought that into the bill, and as we continue to read and realize how much that's really changed things for us. We'll talk about EIDL, what's changed there. money set aside for minority or underserved communities, the Family First Coronavirus Response Act, and SBA 7A and 504 loans, and then some other provisions. So again, our goal is an awareness, and as questions come up, we'll continue to get clarification from the SBA and Treasury to really drill down into what's known. As information continues to come out, just last Friday, the SBA and Treasury announced a few key dates. Today being the first draw. And there's still a little confusion around this from the perspective that first draw for community banks, credit unions, Farm Bureau, services, those type of organizations are going to have the first crack at helping entities that have a first draw need. And those are generally what the SBA and Treasury feel are smaller, underserved minority businesses that the community banks serve. And then on Wednesday, they're going to open up to second draw. So those that have applied for the first one and now can qualify for a second draw, that will open up on Wednesday. And then shortly after, for all lending institutions, a little bit of confusion because the original guidance made it sound like all lending institutions were going to be opening up on Wednesday this week. So again, we get the initial information from our legislators that put it in an act, and then at the end of the day, administration, being the Treasury and SBA, have to figure out how to implement. So it's and had some very tight deadlines to work within that the legislation put into place. So again, pretty excited about some of those changes. Next slide, please. And it's kind of interesting as information comes out. Over the weekend, I spent some time, I'm always checking SBA's website. And on the weekend, I looked and saw, yep, no updates. At the bottom of the screen was what the website looked like. Paycheck Protection Program closed August 8, 2020. Shoot, no updates. And then this morning I got up and said, I better check again just in case. I'm on this seminar today. And sure enough, if you go to the next slide, I found some articles and scrolled down just a little bit further on that same page and realized they actually updated that, the SBA's website, showing the revision to the first time borrower application and the second time borrower application. So fortunately, we were able to get those applications. Banks are starting to open up. As I understand, some banks were already opening up the application process, gathering the information because it's very similar to previous time. So with that, we'll go on to the next page. So as I noted, there's two different applications and two different types of loans that we could have this time around. So certainly the idea here is those that second draws, a key differentiator here is now you have to show a 25% gross decline in revenue over a quarter in 2019 versus a 2020 quarter. It can be any quarter that had a decline. And you also had to use your first PPP loan. And specifically, you don't have to have had used all of those funds by this time, but you will have to use those entire funds. And back on the 6th, they did come out with an interim ruling, which stated that not only, some organizations did not have quarterly financial statements or ability to show a quarter over quarter. So they did say that if you had annual receipts in 2020 that were less than 2019 in that 25% reduction, you could still qualify. And it's kind of interesting when we see the term IFR, we think of it's referred to as interim final rules. So those are the rules that we, SBA and the Treasury puts out that we comply with. Second draw loans are maximum of $2 million. And as noted on the SBA website, there's a new form out for that which is 2483 SD for second draw. For those that didn't apply the first time around, we have the first time draw, which businesses with 500 or fewer employees, and generally speaking, they qualify for other SBA 7A loans. They can be sole proprietors, independent contractors, self-employed individuals, which was the same as last time, but very important clarification. And nonprofits. What was added this time was 501c6 organizations, news organizations. 501c6 tend to be associations, but you've got to be careful because you can't have too much as far as lobbying exposure. And then they have revised, as of last Friday, the Form 2483. So with that, we'll go to the next slide. Other provisions, just thinking about this, the last time you're going to apply for this, it's going to close on March 31st. So one of the things that you can do, and certain people, as I noted, haven't had a revenue decline. You can prove that through your tax return. That's going to be a key document that the SBA is going to be looking for when it comes to revenue decline. Well, the reality is most of us haven't filed our 2020 tax return to show a revenue decline. So we're going to have to rely on financial statements at this point in time. But the SBA also realized that you could submit that revenue decline as from your tax return at the time of forgiveness versus at the application. They've certainly done some things to clarify the seasonal employers. And the other thing they did, and it's really important because if you think back April last year when a lot of people were applying for the PPP, there was a lot of confusion on what type of expenses could be included, how the calculation was supposed to happen. And it was, the fear that they're going to run out of money. So let's get our application in, even if we're a little bit wrong on the numbers. And they did say, hey, if you underapplied last time, you could recalculate and then resubmit for that difference. There's probably going to be some more clarity about how that specifically happens. Or if you got nervous because of the requirements and did I really meet those requirements? So I know some businesses just sent the money back. So those businesses can reapply for any portion that if they've not received forgiveness yet. So again, now that we've got greater clarification, you can go back and reapply. And here's a list of some businesses that are not going to be able to apply this time around. And one is Mike's going to talk about it. They refer to it as the Shuttered Act, but there's some other grants that are available that you might apply for those instead of this PPP round 2. And then if you've got a bankruptcy issue, there are certain special requirements for that. And as I noted, some lobbying organizations wouldn't apply. With that, we'll go to the next slide. Eligible costs, kind of an interesting scenario here. So the first of all, like the PPP one, very similar costs. So we can go back and look at those. One of the things they did do is clarify that we can include group life, disability, vision, and dental insurance. So that was nice that they clarified that for us. Then there's a whole number of other types of expenses that PPE expenses. People had issues with damage to their properties. Those expenses could be covered. Just certain basic operational expenses. Those are all part of this. And it's kind of interesting, and you'll see when we talk about the calculation for how you receive money under the PPP, which is 2.5 times your payroll costs. And then, when you talk about forgiveness, there's another percentage of that. So these additional eligible costs, I'm really working on the calculations, and most people can apply for forgiveness primarily on payroll costs. But as Mike will go over our employee retention credit, we're going to want to start splitting up how we apply for these costs to be reimbursed. And so that's one factor. The other factor is even if we didn't get full forgiveness of our loans, I think what the SBA Treasury legislator is trying to do is make sure that if we spent some of these PPP funds on other types of expenses, that it's going to be okay, because that's what happened to some businesses. Their payroll reduced just because they had to lay people off. And again, this whole program is intended to keep people employed, but they had the money and they spent it on other things. And I think the idea here is to make sure that those expenses aren't going to put them into trouble in any way, shape, or form. So with that, we'll go on to the next slide. So loan terms, as I briefly noted, that you can borrow up to 2.5 times your average monthly payroll costs. And this calculation, there's a couple of different ways you can do it, but that's generally speaking how you arrive at how much money you can borrow. This time around, for some of those hard hit industries, you can apply for 3.5 times your average monthly payroll costs, which is pretty significant. It really helps those businesses that have been hit the hardest, especially, we've had restaurants shut down for many weeks, months here in Michigan. So that's certainly a big help. So on this second draw, your maximum loan will be $2 million. And again, first time draw is certainly, that 10 million that was originally provided. This time around on the second draw, there is a way to get to a 4 million if you're part of a consolidated group. And just like last time, when you go for forgiveness, no less than 60% of the funds have to be on payroll. And a key differentiator here and clarification that happened was before it was an 8-week period or a 24-week period. Now they've allowed you to select a covered period between 8 and 24 weeks. And if, again, you think back to the calculations, if you've got 2.5 times your average monthly payroll and 60% of the costs need to be spent on payroll, if you can go 24 weeks out, it's pretty easy to get, if you're maintaining most of your payroll, it's pretty easy to get to that calculation and have 60% of your funds spent on payroll if you go out 24 weeks. So certainly other costs will make up that 40%, including the additional costs that they allowed. With that, we'll go on to the next slide. So some big changes here. Certainly the loan forgiveness, PPP 1 and 2. So this covers both the previous period and this period when it comes to forgiveness. There's a lot of confusion, a lot of frustration, especially when we got to year-end planning. And it wasn't until December 27th that we really knew what was going to happen. But when they originally passed the CARES Act, they said the forgiveness would not be taxable. The IRS came out and clarified, however, that could be non-deductible expenses, and everybody was nervous about what was going to happen. And finally, as part of the CAA, all of your expenses are deductible and your loan forgiveness is not taxable. If you did file a tax return, so for example, companies that had maybe a September, October, November year end, they've already filed their tax return, they did not take those, they can amend their return. And fortunately, the IRS came out right away and supported the decision by our legislators that those expenses were going to be deductible. So great news. The other key differentiator is the idle advances, or also referred to as grants at times, will not reduce the PPP forgiveness. So what happened in the past, you got one of the, let's call them, most of them are about $10,000. You got a grant up front. The SBA Treasury said, well, that's going to reduce the amount of your forgiveness. So for example, you got a $100,000 loan and a $10,000 advance. What would happen upon forgiveness under the old rules was that you would have $10,000 taken off the top of your forgiveness. So they didn't want you to double dip, essentially. Well, that's been changed, and they've said if you had that $10,000 advance and you had a $100,000 loan, you can get a $100,000 forgiveness, and you can keep that idle advance. So there's certainly going to be conversations with your bank on how you're going to have that last $10,000 forgiven or whatever your advance was. So be in conversation with your financing institution that you got your PPP loan through. And then there's going to be simplified forgiveness. We've been waiting for this for quite some time. We didn't know what the number was going to be, but at the end of the day, if you had a loan of $150,000 or less, it's really signing a one-page forgiveness application and keeping track of that information for your own records, and then just attesting that the PPP requirements were met. And you've got documents that you have to keep if it relates to payroll and employment. You know, how many employees did you have on hand? You have to keep that information for 4 years, and any other documentation related to the loan you'll need to keep for 3 years. And again, if you had a PPP second round or under this new one, and you show the revenue reduction, you need to keep that information as well. So with that, I will turn it over to Mike regarding the employee retention credit, which is a pretty big deal that happened this go round.
All right, thanks, Dave. Yes, as Dave mentioned, this is a greatly expanded and also extended provision within the CAA, and one that we feel under the current situation is going to qualify to a number of businesses that otherwise thought this wasn't applicable to them. The biggest item here is that the employee retention credit, ERC, as you'll hear it referred to, and as we may refer to it throughout this, was set to expire as of January 1st. That has been extended into the first 2 quarters of 2021. Along with that extension is some change in the eligibility provisions, and those changes are, vastly expanding the program to a number of companies that otherwise would not have qualified or did not qualify in 2020 for the ERC. So aside from the favorable changes to the credit and the calculation for eligibility itself, are the expansion to PPP recipients in the first round and the second round, for that matter. Previous to the CAA, we were looking at this as a either or. So going into applying for the PPP loan, companies were running the analysis as to whether or not they were better off to take the employee retention credit or receive a loan under the PPP program. So that's a huge change, and one that while the provisions of eligibility for the ERC are subject to a pretty significant drop in gross receipts, as we'll touch on in a bit, obviously there are companies out there, and many of you, who may be seeing eligibility under that now that the PPP provision, or I should say prohibition, for accessing those is off the table. So the other portion of this, the affiliation limitation, that was also removed, and that had to do with the 50% common ownership of a PPP recipient. Under that provision, if a brother or sister company through the affiliation test had received PPP funding that made, again, the opposite brother or sister to that ineligible for claiming the ERC credit, that's been removed. So again, another taxpayer-friendly item with respect to the change in the provisions for this. And then, as I had mentioned, due to the changes under the PPP and as well as the affiliations test, the 2020 credit will be opened up to a number of employers. Going back and amending the 941s is as we know it right now, the way to claim those credits. There has been some discussion and it hasn't been ironed out. There's some details that haven't been ironed out in which those credits could actually be claimed on the final quarter payroll tax filing. Now that clarity has not been disseminated. So as it stands right now, we're looking down the line that 941s will need to be amended for each of the applicable quarters in which the ERC for 2020 could be claimed. The last piece of this that was a bit of clarity or clarification that was rolled out was for tax exempt organizations. The gross receipt test was something that came into question as far as how do we apply a gross receipts test when looking at the 50% reduction or 20% reduction, which we'll touch on in a moment. And that gross receipts test is based on all gross receipts, not just your unrelated trade or business gross receipts. So it is on the total gross receipts. If we can advance to the next slide, there's a really nice chart here that allows us to do some compare and contrast between the credit, the ERC credit for 2020 and 2021. Most notably, we step on the gross receipts test. Obviously, this is a large item that will open it up to a number of folks in 2021. And so that's the eligibility requirement. There's also one here that I think applies to a large number of folks, and we're waiting on some clarity for this. But there's this idea that COVID lockdown or shutdown order, and how will that apply to businesses, and how can they go about claiming the eligibility? That's one of, as I go through the unknowns or the items that we need more clarity on, that particular piece is one that we're awaiting some additional guidance on this. But beware that the gross receipts test has been greatly reduced from 2020 to 2021, again, from that 50% reduction to a 20% reduction. The maximum credit, stepping up just slightly, the maximum credit has also increased for the per quarter versus a per year. So we went from $5,000 per year to $7,000 per quarter. That's a large increase, not only on the amount of credit that can be claimed, but also when we're looking at it on a qualification per quarter. Again, great advantage to employers, a large credit that's out there to be claimed, provided you can make it through the eligibility requirements and have the wages to substantiate that. So the last piece of this is looking at the change in the number of employees that employers have to qualify for the credit. Under the 2020 credit, that was 100 employees. And you can see where this has been increased to 500 employees. So again, really lowering the hurdle that it takes to qualify for the employee retention credit, making the credit more attractive, expanding it to those who had previously and are still in line to apply for the PPP funding and loans around that. So again, great advantage to employers, one that we feel will really roll this out to a whole host of employers that otherwise were thinking, hey, I took my PPP funding and that's it. That was the end of my decision tree, if you will. Now this is really sparking that conversation up again. I want to go through the gross receipts test very briefly, just to put out an example for folks on the call as far as qualifications for 2021. The 2021 qualification can look back at either 2020 gross receipts or 2019 gross receipts for the quarter. So it's a quarterly qualification. So for those that are looking at 2021 first quarter gross receipts, if they were to fall by more than 20% when compared to first quarter of 2019, that means that you qualify under that provision of the credit. The next thing to look at is whether or not your fourth quarter 2020 gross receipts fell by more than 20% when comparing that to your 2019 gross receipts. If that is the case, you qualify for the first quarter of 2021. So I've seen some questions around the tax community, if you will, CPA community, around the second bullet point there, and that is that you can qualify for first quarter based on the fourth quarter 2020 gross receipts when compared to the fourth quarter 2019 gross receipts. Important factor there, because as it's been also circulated, there's a portion of the credit that can be received through advance payment. So if you qualify for the first quarter of 2021, and they're still rolling out how the advance payment will be applied for by taxpayers, but you will be eligible to receive 70% of your credit in the form of an advance payment. So essentially receiving the credit before the wages in connection with the eligibility around the credit are incurred. As you're probably wondering, how does that then become reconciled? That's reconciled on your quarterly 941. You look at what your credit is that you received for that quarter in the advance payment and reconcile that against the credit which you were eligible to receive. Any excess you would obviously receive as an additional credit going forward. Next slide, please. So, So the next, sorry, a little glitch on my end. The next slide, we talk about the special rules for seasonal employers not existing in 2019. Really, this looks at your gross receipts test and your wages to look at how those wages are applied against your current period. And there are some items within this provision that I think we're going to see more and more clarity on this as things go forward. But know that employers that were not in existence in 2019, it does not mean that, it doesn't mean that you're disqualified from the credit altogether, but you use a different test to measure your reduced wages on a your reduced gross receipts on a quarter by quarter basis. We also talk about hazard pay and bonuses. There was a 30-day wage limitation around that. That also is covered off in the CAA. And it also, the safe harbor, as we talked about, uses, it looks at the prior quarter gross receipts to determine the eligibility. Again, one of these items that it really looks to open up the applicability to a number of different employers where otherwise it was not eligible. Credits can be claimed by retaining a portion of the federal tax deposit. As we talked about, this goes to now completing the Form 7200, which will then allow you to show your applicable wages and the overall credit that you should receive in connection with that. We talked about the advanced credit and the reconciliation around the quarterly 941s. The nature of this, for anyone who's looked at this previously, it's going to operate a little bit like the premium tax credit, in which you'll receive the credit early on, reconcile it against, again, what your overall qualification or total number was. And again, shortfalls or excess will be handled at that point. Again, the big provision, and Dave alluded to this earlier, is as we see the commingling of the PPP forgiveness application with the employee retention credit, where those two items come together are that in 2020 wages, we were looking at, okay, we need to spend the wages in order to qualify for forgiveness. And as Dave alluded to, for a large number of PPP recipients in 2020, they looked at the total wages incurred over a 24-week period and said, gosh, as soon as they extended this out to 24 weeks, I had more than enough wages to qualify for full forgiveness. So they submitted their paperwork with only their wages number. Or they looked at it and said, I know I have all these other expenses, but my application only needs the payroll costs, and they're happy with that. This nuance of the ERC now being applicable back to 2020, and also the intertwining of the payroll calculation with respect to PPP means that employers who are looking to take both PPP forgiveness and ERC and qualify for the ERC are going to want, of the total costs that they're gaining forgiveness on the loan, they're going to want that to be as close to 60% wages, 40% non-wages as possible, because in order to qualify for the employee retention credit, you need to utilize wages in excess of those that were utilized in gaining forgiveness. So what that means is that you need excess wages on a per quarter basis in order to get the qualification and to be subject to claiming the credit. That said, the Treasury and the SBA will need to roll out some guidance for those who have applied, number one, and those who are going through the application, as far as how the wages are allocated throughout the quarters or throughout the period in which the covered period as far as PPP loan forgiveness is concerned. As you can imagine, folks may qualify in the first quarter due to, again, the COVID shutdown, COVID-related shutdowns, or gross receipts reductions. However, first and second quarter are largely when they were utilizing PPP funds to offset wage costs. If they were to look at this in one direction, they could say that your first wages that you incurred were to satisfy PPP forgiveness, and then any remaining throughout the covered period or throughout the year are there for ERC credits. If that is the case, there are a large number of folks who won't qualify, say in third quarter or fourth quarter, because possibly their gross receipts exceeded the 50% reduction. So again, more guidance that needs to come out with respect to that, but just beware that there's a bit of math, if you will, that needs to happen, and some allocations of these wages to understand what the final piece is going to be from an ERC perspective. Next slide, please. All right, this is a new program that was rolled out. I think this is an exciting one, and obviously one that was due for some of our live venue operators or entertainment side of things. And this is, as David had alluded to earlier, this grants for shuttered venue operators. 15 billion set aside in this newly enacted grant program. You can see the list of business types, businesses that were targeted with this 15 billion. We can all imagine and walk through the type of businesses this would apply to, and we see them in our community, and the overall effect that the pandemic has had on these folks. Dave made mention of this, and it's in our slide down below, that I want to make sure that everybody's aware that on the go forward, it is an either situation. You make a decision between whether or not, as a qualifying business under the Shuttered Venue Operators Grant, if you want to take that program or the PPP, call it PPP2, if you will. So businesses will need to understand which one they're going to go with, and not look to double dip on that. It's the credit itself, or sorry, the grant itself is calculated based on a gross revenue, and that's limited to the lesser of 10 million or 45% of the 2019 gross earned revenue. And you're eligible if the gross revenue decreased by 25% or greater when compared to the previous year. There's some distinctions around this, that we're going to need to look at which credit, or I should say, which program gains the best advantage for those businesses. There's 15 billion set aside. That's not nearly as much as the PPP program, so I would suspect that will go quickly. And so businesses will need to be on their toes and ready to apply for those, but also know that that this grant potentially has a cap of $10 million when, as Dave mentioned earlier, under the PPP, you're looking at a $2 million cap on that. And so there's a bit of looking down each road that needs to happen in order to decide which item is best for you. Next slide, please. And now Dave will dive in on talking about the EIDL program and the expansion of recent times. Go ahead, Dave.
Thank you, Mike. Wanted to make sure we understand again that there's information coming out fast, and certainly we're looking for some additional information on the whole EIDL loans, the economic injury disaster loans. They did talk about additional $20 billion of funding for the EIDL loans. And they're also reopening the EIDL grant advance program. And as we continue to read, there's a lot of varying opinions on what that means as far as the EIDL grant advance program is reopening. What is clear is that if you did get a grant the first time around, you could, and you qualified for a higher amount, you can reapply and get that difference up to that 10,000. So again, very clear, and you have to have experienced a 30% reduction in gross receipts in that specific period. So that's a little bit of confusion. I think they've opened up and provided more funding for overall EIDL loans, which have essentially a 3.5% interest rate and a very long-term payback. However, on the grants, when we talk about a grant, the SBA cannot actually give a grant. So they're really in advance that they're forgiving the indebtedness at that point in time. And there's a big question out there for, have they opened up that advance program where you could qualify for that 10,000? Many businesses were maybe late to the game and were not able to participate that first time around. And that's a big question I'm waiting to see answered. I have not seen anything regarding that on the SBA or Treasury for clarity. So as soon as we get information, we'll get that out. But they have provided significant funding for some additional EIDL loans. Another big thing is, as I noted earlier, the grant does not impact your eligibility for PPP funding. So, or if you just get a loan under the EIDL, that does not exclude you from getting PPP loans as well. Next slide, please. So one of the things that's happened, and they talked about it today, the Treasury did when they talked about the dates opening up for loans, is that there's set-asides for specific minority-owned businesses. And we talk about set-asides, yes, they've set money aside. One, two, they are trying to get those smaller institutions that are in the communities that aren't served quite as well, and they've opened up loans for that. But it's interesting, the SBA only anticipates that about 25% of those funds, that 15 billion that's been set aside, will actually be used. So I think there's a real opportunity here for the chamber and other organizations to work on making sure that the lower served, low income neighborhoods, minority businesses all get the appropriate PPP funding. So I think that's a great opportunity for the chamber, that we can work together and make sure those organizations get that money. It's interesting, they talk about a matching program that the CDCS is going to be matching some of these businesses with financing institutions to get the money. So for those low income neighborhoods, those businesses that are minority, I thought, what does the CDCS have to do with matching here? And because I certainly didn't think it was the Center for Disease Control. And I think it's actually a credit specialty financing group that's going to be doing that matching. But again, the crazy part is I didn't know about that organization. So who is going to know about that organization? So it's really important that I think like I said, the chamber gets the message out to members. So appreciate the opportunity to do that today. With that, we'll go to the next slide. And the reality should businesses prepare. Additional guidance will continue to come out this week. As I said earlier, the applications came out late last Friday. Not quite sure when they were posted on the website, but yeah, the applications were done last Friday. And these first few days, and again, there's a little bit of confusion there. The documentation originally said all institutions would be opening up to submit loans. All financial institutions would be able to submit loans as of Wednesday this week, but then Treasury came out last Friday and said that will be shortly thereafter. So still a little bit of wait and see, but I do know that banks are working on taking applications. So the big next step here is really be in conversation with your CPA and your bank. Find out what their process and timeline is at the lending institution. And if your lending institution isn't able to help, certainly there's other organizations out there. Review the qualifications as Mike put on his slide for the ERC and then the PPP, the reduction. Again, you've got a quarter over quarter qualification. And let me note too, when you talk about that revenue reduction, they do not include in that revenue your PPP loan forgiveness or your EIDL advance or grant that you received the first time. So you do not need to include those dollar amounts in your revenue calculation. Start gathering your documentation. Again, most banks have their own portal and requirement for collecting that information. So be in touch with them, but a lot of it has to do with your payroll and some other costs. And at the end of the day, what you're able to do is submit that, and your bank's going to help you with the total application. And even if you're using a third-party payroll processor, many of those have some reports you can run right out of your system. And the reality is, stay tuned. Additional information is going to be released. As I know on the internal final rulings, a few came out on the 6th of January. And the first one was 82 pages, which was a consolidation of the many interim final rulings that came out last year. And then the second one was really about the CAA and the second draw and all the changes that we've had. So those are key documents that we continue to read and reference, because that's, again, that's how the Treasury and the SBA have pulled together the information and how they're administratively going to carry out what the legislators passed in our act. So with that, we'll go to the next slide. And Mike, did you want to take that one, or did you want me to?
Yeah, I got you, Dave. So one of the items that came about with the CAA was also the Family First Coronavirus Response Act. That's the FFCRA. And for those of you unfamiliar with this one, this looks at voluntary or mandatory offerings around the payment of wages during those who were off or on leave or caring for loved ones who were affected directly by the COVID-19 virus. While that's the mandatory portion of that ended as of the end of the year, what was extended into the first quarter was the credit available for voluntary offerings for employers who offer this to their employees on a voluntary basis. And so the sunset of the mandate program and the reimbursement program was at the close of 2020. the CAA, again, provided employers the option of continuing this with the advantage being that to qualify for the credit related to those wages paid. So the qualifying reasons have not changed. So again, there's a host of reasons why an employee can be eligible for the leave under the FFCRA. So those items haven't changed. What has changed again is it's gone from a mandatory to a voluntary basis, and on top of that, it's now in a credit form for those that are offering through the voluntary program. Suggestion to those of you who will be offering this on the go forward, again, through the first quarter, make sure that you started in on documenting this and that your employees are aware that you're offering this and that it's out there for them, and putting policies in place as to what documentation needs to happen in order to understand that you do have an employee who qualifies under this program.
Mike, I'd like to just add one more thing that we're still looking for some clarification. Certainly this was based on 80 hours for an individual sick leave, or up to 12 weeks for somebody that was, like Mike said, caring for an individual related to COVID. And what happened is they're saying, first of all, if somebody's already claimed that 80 hours or 12 weeks credit in 2020, they can't do that again. However, if your employer's plan automatically offers a employee an additional 80 hours or 12 weeks, and under the FMLA, there's a possibility that you can get another credit for that same employee, but everybody's looking for some additional clarification at this point in time. So anybody that did not claim it in 2020, certainly, as Mike said, it's voluntary to offer that and then take the credit in 2021. But if somebody did have use a portion of the 12 weeks that you paid and you received the credit, we've got to get some additional clarification for 2021. Thanks, Mike.
Yeah, great point, Dave. Also, I do want to point out, this is focused on the CAA. However, a number of states had programs that were in place. For those of you who are on businesses that have employees across different states, I know New York and California are working on their own form of this as well. So just keep your eyes peeled. Again, this is more focused on the federal aspect of this, but there's more to come on some of the state items. Next slide, please. All right, this one, I feel like this provision of the CAA did not get the press that certainly the PPP2 got, and even less so to some degree than the ERC received. And that is the extension of the SBA 7A and 504 loan debt forgiveness. Just to recap where we were at and what had happened as a result of the CARES Act. Those who had an existing 7A 504 loan as of February 15th of 2020, they received what was 6 months worth of payments on the existing loan covered by the SBA. And that was not a deferral, that was actually a loan payment that was covered by, again, the SBA on behalf of those who were, who were in the SBA 7A or 504 program. That also applied for a window after February 15th, and that was that if you entered into a 7A or 504 loan before September 20th of 2020, you were also receiving the 6-month payment coverage. So that was a great program, and I will say that as somebody who sits on the transaction advisory side of things, we were seeing where that was a bit of a driver from an M&A perspective, or at least was an opportunity to sweeten the pot on these deals, because to the extent that you were entering into a 7A to, again, either go through an acquisition, that was attractive, again, to receive that 6-month coverage on the 7A loan. On top of that, the other part was the 504 and any expansions that were happening, or substantial equipment purchases, things of that nature. So I put that out there that that this was a little bit of a catalyst around some M&A perspectives, but also just as businesses were looking to respond to the pandemic and frankly be as nimble as possible. This was a great provision. What has happened as a result of the latest stimulus package, this has this nice provision for those in the SBA program has now kicked up for an additional time period. There's a couple of provisions. One is that we now see where there's going to be an additional 3 months of payments made on behalf of those who held a loan, an SBA 7A or 504 loan, previous to that September 20th drop dead date around that piece. So they're going to receive an additional 3 months. If you're wondering when that time span is, it's going to begin in February of 2021. To some degree, that aligns with receiving the 6-month payment coverage that you would have under the deadline. So effectively, those who are last in the door will receive a continuous 9-month payment, if you will. For those who had an established one, they've now assumed repayment of those loans under their own funds. They'll again receive this 3-month additional time period of loan coverage, debt coverage. The next piece is that for some folks in the deemed hard hit sectors, they're going to receive an additional 2 months on top of that, so a total of 5 months of additional debt coverage. And just to hit on the tax aspect of this, because I know this was a question as things went through. This one, from the debt coverage perspective, the principal portion of the payment will be taxable to the business. So effectively, one of the things we want to say here is that you will receive the full payment. You'll get a 1099 from the SBA for the full amount of the payment, and you'll be able to deduct the interest. So that's the way that it's going to go for 2020. There's no reason to assume it's going to be any different for the 2021 coverage. And the last piece that's come up as a result of this is that they're going to reopen this entirely. So now newly established 7A and 504 loans, beginning from December 22nd through and the end of September 2021, will also receive that initial 6-month covered period from a loan service perspective. So again, really attractive stuff here. For those in the M&A side of things, obviously very exciting to see this put out there. Whether or not it's a integral driver of the M&A activity, or whether we'll see this as just another another throw-in, if you will, to say, hey, this may be time to look at that deal that you've been contemplating, or that capital improvement that's been out there. So if we can advance to the next slide. So we covered a lot of this early on, but really as kind of a revisit, it's been expanded to include the 7A and 504 loans established between, again, December 22nd and September 30th. They get the initial 6-month forgiveness. Again, that matches the provisions of the CARES Act. So that's to say that anyone who enters into a loan on a go-forward basis will get those same coverage provisions. If we dial this back to the PPP round, those who didn't take the first round of funding, as Dave mentioned as we were talking through that, there's a lot of this that looks to match or mirror those for maybe folks who weren't so sure on things and now are entering back into the program, that they're getting some of those same provisions that, again, those folks did that were into the program at that point in time. And then again, just a general reminder that 7A and 504 loan forgiveness is taxable in the entirety of the payment. However, you'll be able to deduct the interest component of those forgiven payments. Next slide, please. All right, so on top of all of the other items that we've covered, there were some other tax provisions that we just want to quickly shed some light on. The business meal deduction, this did get some headlines along the way, both positive and negative. But this one is that businesses can deduct 100% of the business-related meals during 2021 and 2022. Previously, those meals deductions were limited to 50%. So again, small for most folks, but there are folks that are, they're going to look at this and see the tax advantage, however sizable that may be. There are also a list of additional tax extenders and credits that were, again, pushed out and extended for the periods, the go forward periods. Some of these are, just in case you're wondering, but the work opportunity tax credit, new markets tax credit, empowerment zone tax incentives, those are the ones we see probably most often out of these. So with that, I believe we'll turn it over to the Q&A.
Awesome. Thank you so much, guys. That was wonderful. We are at our time, but I know that we have some questions in the chat, so we're going to do kind of a rapid fire. And some of these we might have already covered, but I just wanted to reiterate for attendees. So I'm going to just jump through them as quickly as we can. The first question, for round one, we had to use the 8-week time period because we are on semi-monthly payroll. Is it different for round two?
So, Lex, I'll take that one. I believe it is different. They did say between the 8 and 24 weeks, you can choose that, but certainly there might be some clarification on that, but I believe it is that you can extend that time period.
Wonderful. Second question, if you get PPP 1 and 2, will that combined be figured at the $150,000 loan, or are they separate loans?
Good question. I believe they're going to consider those 2 separate loans and 2 separate sets of forgiveness. So that's interesting question, though. Because collectively they could be over the 150 and individually they could be under 150. So I'm sure there'll be clarification on that.
Wonderful.
Yeah, I've seen much the
Mike,
same.
did you want to add? Okay, wonderful. Next question, will forgiveness be similar to round one, where it would be reduced if we decrease staff, or do we just need to show that we spend the funds on payroll and other expenses?
Yes, the forgiveness process will be similar with the reduction in FTE count as well.
Wonderful. Next question, if we were a new business in 2019 with no sales in Q1 and Q2, are there provisions for comparing gross revenues for second round PPP?
It's, yes, there are specific requirements for new businesses or seasonal employers, which allow you to compare, quarter over quarter for those that you're open. So specifically look at those set of guidelines.
Wonderful. Wondering where the 25% use estimate of the set aside came from. Why was that amount set aside? If not, all of it will be likely used. And also, how is underserved, et cetera, being defined? What makes a business eligible for that pot?
That's a good question. I brought that point up too, because in the reading and the legislator, the SBA, Treasury, they've got a concern that that money is going to get out there for the underserved. But I think the good news is they're allocating a set aside for that, and there is some specific guidelines on how they define those neighborhoods and those businesses. The important part is that they've set it aside so that those businesses probably aren't going to be the first to the table and get the money. And what happened last time around is maybe they were too late to the table to get that allocated. So, I don't know exactly where that 25% came in or why they said that, but it just surprised me that they actually admitted to that there was going to be a concern. So we've got until March 31st. Let's work with those organizations.
Right, great to see that provision too. Another one, is there any additional information on the funds available to minority low-income businesses? How are they being determined where the low-income neighborhoods are? And are these services eligible for the businesses that do not have or are these services available for these businesses that do not have a banking relationship?
Yes, there are services available. There's actually the AICPA has sponsored with a number of organizations an online application, and I certainly can get that to Alexa and the chamber. It is something that I'm working on, is how do we help the chamber, support those type of businesses for those services. And, we do need to get that information out. Certainly appreciate the chamber sponsoring this event to get the word to the community. Did I answer all of the
Wonderful.
questions there, Alexa?
I think so. We have
The
two last
multi-part.
ones. Two last ones that we can do rapid fire. First one being, where do we find out if we are operating in a low income neighborhood for the EIDL grant?
So the EIDL grant, that's a good question. The SBA and the Treasury have put out a document, and I'm trying to remember if it was on Treasury's website, or I think it was on Treasury's website, and I'll make sure I send out a link with the slides. We can add to the slides.
Beautiful. Thank you so much. Last question. Can we apply for the venue money, and then if you don't get it, apply for PPP?
I can take this one, Alexa. Yes, the short answer is yes. And I would encourage those that are looking at the venue money to look down that road, because I think that's going to be the one that is going to be of greatest yield. But as I mentioned, as we were going through it, the $15 billion, I expect that will go quickly, and the PPP will have more funding that will trail on and be exhausted at a later date. So again, go for the Venue Act, at least if your analysis is the same as mine, and then look to the PPP as a fallback option if that happens.
Wonderful. Thank you so much for the rapid fire. Again, this will be posted on our website, so that way folks would be able to get their questions and hear the answers to that too. Since we're over time, but just real quickly, both of you guys, any last words of wisdom for our members before we conclude today's event?
The key item there is stay tuned, have conversations with your professional advisors as well as your bank. They're going to be able to coach you and guide you through this process.
Couldn't have said it any better, Dave.
Perfect. Thank you so much. And thank you for joining today's discussion. The town hall has been recorded, and like I said, we will be posting this on our website, grandrapids.org, for attendees that were unable to tune in today. The Government Affairs team will be keeping members up to date on the latest information as it becomes available. If you have any questions in the meantime, please reach out to one of our team members. This concludes today's event. Be well and have a wonderful week.